Most people think markets react to bad news the moment it becomes visible. That is not usually how it works. By the time a headline feels urgent, a lot of the repricing has already started somewhere else. In shipping routes, in insurance costs, in commodity spreads, in the decisions large buyers make before the public is fully paying attention. That is the part worth watching. What matters right now is not the noise. It is the shift underneath the noise. A disruption does not need to look dramatic on your screen to matter. It only needs to change the flow of something the global economy depends on. Energy is one of those things. When the movement of energy becomes less predictable, markets do not wait for certainty. They start adjusting early, unevenly, and often without much explanation. That is why this moment deserves a calm look. Not because every disruption becomes a crisis, it does not. But because when a market starts repricing risk before the broader public has framed the story correctly, that gap matters. And if you are managing capital, even modest capital, you do not need to be alarmed by that. You do need to notice it. That is where I want to begin. Over the past several days, shipping activity through the Strait of Hormuz has slowed noticeably. This narrow waterway connects the Persian Gulf to the open ocean and is one of the most important energy corridors in the world. According to the U.S. Energy Information Administration, roughly 1/5 of globally traded petroleum liquids move through this passage each day. That share has been relatively consistent in recent years. Several developments have been reported in the region. Maritime monitoring services and shipping trackers have observed vessels waiting outside the strait, while some operators reassess routes and insurance coverage. Insurance premiums for ships operating in the Gulf region have increased, a common response when geopolitical risks rise. None of this is unprecedented. Shipping markets tend to adjust quickly when uncertainty appears. Energy markets responded almost immediately. Oil prices moved higher during recent trading sessions as traders incorporated the possibility of supply disruption into pricing. Price movements of that type often occur before any physical shortage appears. Commodity markets react not only to confirmed changes in supply, but also to shifts in perceived risk. At the same time, governments and energy agencies began monitoring the situation closely. Many major economies maintain strategic petroleum reserves specifically for periods when supply flows become unstable. These reserves function as emergency buffers rather than everyday supply sources. Some financial institutions have also begun discussing the situation with clients. For example, analysts at J.P. Morgan Chase have circulated research notes outlining potential market implications. In those notes, the bank discusses possible scenarios for oil supply disruptions and the pace at which storage capacity and logistics might adjust. These documents describe potential developments, not confirmed outcomes. What has changed compared with last week is relatively simple. Shipping patterns in a critical energy corridor became uncertain. Oil markets began pricing that uncertainty. Governments and market participants started evaluating contingency plans. Those are the observable facts so far. Energy disruptions rarely stay confined to the place where they start. Oil, unlike many commodities, sits at the base of multiple economic systems at once: transportation, manufacturing, agriculture, and electricity generation in some regions. When the flow of oil becomes uncertain, markets begin recalculating risk along that entire chain. The first layer of impact is logistical. If shipping traffic slows through the Strait of Hormuz, producers inside the Persian Gulf may temporarily face constraints moving crude to global markets. This does not immediately remove supply from the system, but it changes how quickly supply can reach refineries and trading hubs. Once logistics become less predictable, pricing begins to adjust. Oil traders do not wait for inventories to fall before reacting. They adjust futures prices based on the probability that supply could tighten. That is why commodity markets often move ahead of physical shortages. From there, the second-order effects begin. Countries that rely heavily on imported oil, particularly in Asia, monitor these disruptions closely. According to data from the International Energy Agency, several large economies maintain strategic petroleum reserves precisely for moments when transportation routes become uncertain. These reserves allow governments to stabilize supply if imports slow temporarily. However, even when reserves exist, markets still respond. Importers may increase purchases from alternative suppliers, shifting demand toward producers outside the Gulf region. That redistribution can push prices higher globally, even in regions not directly dependent on the disrupted route. Energy costs then move outward through the economy. Transportation expenses rise first, followed by shipping costs. Manufacturing sectors that depend heavily on fuel inputs begin recalculating margins. Agricultural production, which relies on both fuel and petrochemical fertilizers, eventually feels similar pressure. The transmission from oil prices to consumer inflation is not immediate, but historically it has been consistent. Financial markets react to that possibility. Higher energy prices can complicate the work of central banks. Institutions such as the Federal Reserve and the European Central Bank monitor commodity-driven inflation closely because it can influence interest rate policy. If energy costs accelerate while broader inflation remains elevated, policymakers face a difficult balancing act between controlling prices and sustaining economic growth. Another layer of response occurs inside financial portfolios. When energy volatility rises, investors often reassess exposure to sectors sensitive to fuel costs. Airlines, logistics companies, and heavy manufacturers are particularly responsive to oil price fluctuations. At the same time, commodity-linked assets sometimes attract attention as investors seek diversification. None of these reactions occur all at once. They unfold step by step. A shipping disruption leads to logistical uncertainty. Logistical uncertainty alters market pricing. Market pricing influences policy expectations and investment behavior. That chain reaction, rather than the headline itself, is what markets are trying to interpret. When energy markets tighten, investors often look backward for perspective, not because history repeats neatly, it rarely does, but because past episodes show how markets behave when supply routes suddenly become uncertain. One reference point is the 1979 oil crisis. During that period, political instability in Iran disrupted oil production and export flows. The global market was already tight at the time, and the loss of supply triggered a sharp increase in crude prices. What is often overlooked is the sequence of events leading up to the price spike. Shipping disruptions, declining inventories, and uncertainty among major buyers all appeared before prices moved dramatically. Another relevant example occurred during the Gulf War. Oil markets reacted quickly when supply from Kuwait and Iraq became uncertain. Prices initially surged, but they later stabilized as other producers increased output and strategic reserves helped offset the disruption. The key takeaway from that episode is that markets often price the possibility of shortages long before physical shortages fully materialize. More recently, there were temporary tensions affecting the Strait of Hormuz in 2019. Several tanker incidents occurred in the region, prompting brief increases in insurance costs and shipping risk premiums. Oil prices moved higher during those weeks, but the effect faded once shipping flows normalized and global inventories remained adequate. These examples highlight a pattern. First, markets react quickly to perceived supply risks. Second, governments and producers often respond by releasing reserves or adjusting production. Third, the final economic outcome depends on how long the disruption lasts. That last point matters most. Short interruptions tend to produce price volatility rather than long-term shortages. Extended disruptions, on the other hand, force structural adjustments in energy supply chains. The current situation shares some characteristics with earlier episodes, primarily the importance of a critical transport corridor. But there are also important differences. Global energy markets today are more diversified than they were in the 1970s. North American production, expanded LNG trade, and larger strategic reserves give governments additional tools to respond if supply flows tighten. History, then, does not provide a prediction. What it offers is a framework. Energy markets tend to react first to uncertainty, then to actual supply changes. Understanding that sequence helps reduce the temptation to interpret every disruption as a permanent shift. Professionals rarely treat market developments as a single outcome. Instead, they work with ranges of possibilities. The goal is not to predict the future with certainty, but to understand which conditions would push the market in one direction or another. Below are three broad scenarios analysts often consider when a major energy transit route becomes uncertain. Kidney bull case, supply tightening persists. For energy prices to continue strengthening, several conditions would likely need to occur together. First, shipping constraints through the Strait of Hormuz would need to persist long enough to disrupt the steady flow of crude exports from Gulf producers. If tanker traffic remains limited or insurance costs stay elevated, Fewer shipments could reach global markets in the short term. Second, global inventories would need to decline faster than expected. Oil markets are sensitive to storage levels. If commercial stockpiles begin falling across major importing regions, traders often interpret that as confirmation that supply is tightening. Third, demand would need to remain stable. According to forecasts published by the International Energy Agency, global oil consumption continues to grow modestly each year, largely driven by emerging economies. If demand growth continues, while supply becomes constrained, prices could move higher as markets rebalance. Under those conditions, sustained logistical disruption, falling inventories, and steady demand, energy markets would likely remain firm. Commodity-linked sectors, including energy producers, might benefit from that environment. Base case, temporary disruption, gradual stabilization. A more moderate path is also possible. In this scenario, shipping disruptions remain short-lived. Tanker traffic resumes gradually as security conditions stabilize and insurance markets adjust risk premiums. Governments may release limited volumes from strategic reserves if needed, providing temporary supply support. Financial institutions often emphasize this possibility. Analysts at J.P. Morgan Chase, for example, have noted in research reports that oil markets frequently stabilize once supply routes reopen or alternative shipping arrangements emerge. These comments are forecasts based on historical patterns, not guarantees of what will happen. If the disruption proves temporary, oil prices might remain volatile for a period before settling near previous trading ranges. In that environment, energy costs could rise modestly without creating a sustained supply shock. Bear case, demand weakens or supply adjusts quickly. The third scenario involves a faster adjustment on the supply or demand side. If major producers outside the Gulf region increase output, global supply could offset the disruption relatively quickly. North American producers, for example, have historically responded to higher oil prices by expanding drilling activity, though the timing varies. Demand conditions also matter. If economic growth slows in major importing regions, including Asia or Europe, oil consumption could soften. Lower demand would reduce pressure on prices even if shipping routes remain somewhat constrained. Another factor could be coordinated policy responses. Governments may release reserves or adjust trade flows to prevent extended shortages. These measures often dampen price spikes if implemented early enough. Under that combination, rising alternative supply, softer demand, or coordinated policy responses, oil markets could stabilize sooner than expected. None of these outcomes is predetermined. Professional investors typically prepare for several paths at once. Markets evolve as new information arrives, and the balance between supply, demand, and policy response determines which scenario becomes more likely. When markets move quickly, the hardest part is filtering signal from noise. Headlines tend to focus on the most dramatic element of the story, but professional investors usually track a small set of indicators that reveal whether the underlying conditions are actually changing. One of the first indicators I watch is the US dollar index. Energy and most global commodities are priced in dollars. When the dollar strengthens, commodity prices often face downward pressure because imports become more expensive for other currencies. If oil prices rise at the same time the dollar strengthens, that typically signals genuine supply stress rather than currency-driven movement. The second indicator is the behavior of U.S. Treasury yields, particularly the benchmark securities issued by the U.S. Department of the Treasury. Bond yields reflect expectations about inflation and economic growth. If energy prices begin pushing inflation expectations higher, yields often respond quickly. Watching that relationship helps determine whether oil volatility is feeding into broader financial conditions. Inflation data also matters. Reports such as the Consumer Price Index from the U.S. Bureau of Labor Statistics and the Personal Consumption Expenditures Index published by the Federal Reserve provide insight into whether higher energy costs are spreading into the wider economy. These indicators tend to move more slowly than markets, but they shape monetary policy decisions. Inside commodity markets themselves, positioning data is another useful signal. Open interest in futures positioning can reveal whether price moves are driven by physical supply changes or by short-term speculative activity. A rally supported by rising open interest often indicates broader participation, while a rally on declining participation may fade more quickly. Liquidity conditions are also important. Periods of geopolitical tension sometimes coincide with thinner trading volumes, which can amplify price swings. Watching trading depth and volatility helps determine whether movements reflect structural changes or simply temporary market stress. Finally, I pay attention to inventory data and shipping flows. Satellite tracking, tanker rates, and storage reports often reveal logistical changes before they appear in economic statistics. In energy markets, transportation and storage are as important as production. These indicators do not provide certainty. What they offer is a framework for understanding how the market is processing new information. Markets move through periods like this more often than people remember. A disruption appears. Prices react. Analysts debate what it means. Then the situation gradually resolves into something clearer, sometimes calmer, sometimes more complicated. The important thing is not reacting to the loudest narrative in the moment. What matters is process. Watch the data, understand the chain of cause and effect. Adjust risk gradually, not emotionally. Energy markets in particular have always been sensitive to logistics and geopolitics. That does not automatically mean a short disruption becomes a long-term shift. Sometimes it does. Often it doesn't. The role of an investor isn't to predict every outcome perfectly. It's to stay disciplined while the market figures things out. So for now, I'm watching the indicators we discussed and letting the information develop. This isn't investment advice. It's simply how I'm reading the market right now.